have seen the run-up in global equities, as this chart on the Bloomberg shows, right? I mean, with that rally in the tech sector, even consumer discretionary gaining about 26% or so in the first half. Will those recession fears, earning downgrades, finally start to hit in the second half?
Well, that is a fear. I mean, recession has, eluded the markets. I mean, the markets have got it wrong. I mean, many of us have thought recession will, happen in the first half of this year. It's not, and that's one of the things that, analysts have got wrong. And the markets have responded by, the MSCI Global Index is up quite sharply, as you said. But as you go into the second half of this year, the concerns about recession will come back into play. No doubt the U.S. Employment numbers and the economic data recently have been stronger than expected, but with high inflation, with high interest rates, I think it's possible that economy will face some downward pressure, and so recession fears could start creeping back into the market towards the end of this year, perhaps early next year. Earnings downgrades could then start impacting the markets, because historically, when earnings get downgraded, the markets do take a hit. But right now, I think, the recent data points to the fact that the economy is resilient. So earnings downgrades are not, the key focus at this juncture, but I think they will become more of a focus down the road.
Will cash become more attractive?
Well, cash is attractive at this juncture. I mean, yields are going up, as you mentioned earlier. But having said that, I think it also doesn't make sense for investors to hold on to cash or sit on cash, a large amount of cash, given the fact that we still are medium-term positive in the markets. We think that once we go past this recession, there's a lot of idle liquidity on the sidelines. Once the Fed cuts rates, I think historically what the markets have shown is that we'll see a rally. So I think the best strategy right now, we are telling our clients, is really to drip feed into the markets, to dollar cost average. No doubt hold a bit more cash than usual, but definitely not majority in cash at this juncture.
So the strategy, I think, that you've pointed out is potentially to just hold on tight for the rest of 2023 as we get into that, the end of this tightening cycle globally. How do you position some of the pullback so that perhaps you can see better returns in 24?
Well, we are telling our clients, sure, buy gradually. We're not saying stay out of the market, stay invested, but invest carefully, invest gradually. Invest over time for time diversification, and where we see opportunities, we see opportunities in several areas. For example, among developed market investment grade bonds in general, especially the ones with long duration, because when interest rates are cut, historically, you see that the bonds with long duration will tend to outperform, and investment-grade bonds offer you a hedge against a potential recession that could hit us in the next perhaps 6 to 12 months or so. I think beyond that, in Asia, we like Japanese equities. They've done very well, but we think that they could have more upside going forward. The weak yen is positive for Japanese equities, and a whole host of other factors. Corporate governance has improved, shareholder returns have improved. Japanese companies are sitting on a lot of cash. They could pay out higher dividends. And, the economy is resilient, more resilient than the US and Europe. And so there's a stronger case for investors to look at Japan. And now with the inflation numbers coming in below expectations, clearly the BOJ could keep monetary policy looser for longer. And there are very few central banks around the world, adopting loose monetary policy, and the BOJ is one of them.